I recently learned something that is unbelievable. The last 20 years have delivered great returns to investors. However, look at this chart from 2001 to 2020. The average investor received a 2.9% annual return. That's horrible. It's barely above inflation. Buying and holding nearly any asset class, even bonds, would have earned at least double the return. So why is the average investor getting crushed? I think it's because they get caught up in the hype of market trends, fads, and emotions. They're investing like a noob instead of a pro. After watching this video, you'll know the 6 steps to start investing like a pro. Step 1. Understand your investment goals. For most people, this is going to be achieving financial independence, smashing the like button to support free financial education, what a noble goal, and leaving a legacy for their family. For example, a hypothetical person's goals might be retire at age 50, have an annual income from investments of $60,000, pay off our house by retirement, and leave a significant inheritance for our children. Step 2. Determine your investment philosophy. In my opinion, the simpler this is, the better. For instance, my wife and my investment philosophy is, we are optimistic about the future innovation of mankind. We'll invest in global market cap weighted index funds to obtain the global market return. Our ability to earn income is the most valuable asset we have. We will invest in ourselves to increase our own value and to provide a larger income stream for investing. In my opinion, this is the most likely path to wealth. Some people will try to sell you various trading strategies or hot stock picks. These people make their money from selling courses, not from investing acumen. Instead, I recommend focusing on getting a promotion, starting a business, or other means of increasing your value. This is extremely powerful because it will give you more money not just once, but every single year. The money will result in a higher investment income. A hot stock pick is not repeatable. Earning income from a valuable skill is repeatable. Step 3. Determine your risk tolerance. Some people invest like they need to be a billionaire by tomorrow. Seriously though, I've seen many people get caught up in taking on more risk than they need. This might be one of the most difficult aspects of becoming a successful investor, due to emotions you encounter when you see other people getting higher returns than you, or when you've been diligently investing and see a market crash obliterate your portfolio in days. These emotions are really difficult to manage, but you need to plan for them and deeply consider your risk tolerance and your goals. Look at this table I put together. This has the different average rates of returns from top to bottom that we saw in the table for 2001 to 2020. From left to right, we have the number of years of working and investing every month. The amount contributed every month is highlighted in orange. In this example, it is $1,000 per month. In my opinion, you should target the blue area of this graph. What matters the most here is time and how much you invest. Compounding is very powerful, and even more conservative portfolios are likely to get you to your goals. Instead of trying to be the unicorn investor, I would focus on doubling your income and investing more. If we increase the monthly investment to $2,000 per month, the table is even better. And $4,000 per month is even better than that. Stop and ask yourself if chasing higher returns is really worth the energy and the risk. The statistics are not in your favor. You're more likely to get returns like the average investor than the unicorn investor. A higher income is far more assured, and there is almost no risk to improving your skills and value. All right, I'll stop beating this one to death. Step 4, determine your asset allocation. I have several videos on this subject which you should watch. They are linked below. The basic idea is you should determine how much exposure you want to each asset class. The most important asset classes are stocks and bonds. Stocks will drive the growth in your portfolio, and bonds will serve as capital preservation and to decrease the risk. Once you decide on this split, you can further split your stock or bond investments to target different sectors of the market. Some people will also add REIT funds, gold, cryptocurrencies, or other alternative asset classes. An example asset allocation is 50% US stocks, 30% international stocks, and 20% bonds. You should determine your asset allocation to align with steps 1 to 3, your investment goals, your investment philosophy, and your risk tolerance. Step 5, decide which investment accounts and funds to use. A critical piece here are the tax-advantaged retirement accounts. They can help you avoid paying taxes. For most people, there are 3 of these: the 401k, IRA, and HSA. You should learn about the basics of these accounts, what the early contribution limits are, and decide how much you will contribute to each. Once you determine this, you will need to choose the mutual funds or ETFs to match your asset allocation. In my opinion, you should use index funds since they are low cost and outperform most actively managed funds. Why pay more for less? I use a variation of the 3-fund portfolio. It's simple but very effective. It has a US stock index, an international stock index, and a US bond index. If you want to be hands-off, you could use a target retirement index or balanced index fund. I have videos discussing tax-advantaged accounts, various index funds, and even how taxes impact which funds go into which accounts. Make sure to subscribe and check them out. This step may sound complicated and lead to analysis paralysis. Don't let this happen to you. For most people, consistently contributing to tax-advantaged accounts with a simple target date retirement fund is sufficient to meet your goals. I wouldn't worry about trying to optimize it perfectly. I would just keep things very simple. If you're starting out by investing in retirement accounts like a 401k or IRA, you can always change it later once you learn more. Step 6, maintenance. This step should include various rules for maintaining your portfolio. If you're holding multiple funds, you should have a rebalancing rule to keep your portfolio at the target allocation. For me, I rebalance once per year in January or when my portfolio drifts 5% from my target allocation. You could specify that you will make automatic contributions if possible. You should also detail how you will make changes to your portfolio. For instance, you may want to make a rule that portfolio changes are only allowed due to life events or only after 6 months of consideration. You might remind yourself that you will not engage in market timing or chasing fads, as most people fail miserably. The whole point of this last step is to set up additional boundaries on your investment plan, to automate it, and to keep you on course. I recommend creating a document to outline these 6 steps. This document is called an investment policy statement. This is a long-term strategic plan for achieving your goals. This is how pros invest. They create a sound strategy and they follow it instead of getting caught up in the hype and short-term trends. Here is the investment policy statement we put together in this video. I'll put a link to it below. This is a basic plan. You can always add more, like insurance policies you'll buy, more detailed strategies for taxes, or withdrawal strategies for retirement. Even if you don't have precise details for the whole thing, just get started and keep it simple. This will be a living document. You can iterate on your first version, then change it slowly over time as you become more experienced or as life changes. Every time you make a change, I recommend creating a separate copy of this document with a date on it, so you can easily see how often you're changing it and how your plan has evolved over time. If you're changing it often, something is probably wrong. The important thing is to document your investment policy and then to follow it. The investment policy statement is also beneficial if one spouse is more interested in investing than the other. The goal should be for either spouse to be able to pick up this document and manage the portfolio. You should work together to create it and keep it simple but detailed enough for either of you to manage. Thanks for watching, everyone. Make sure to smash the like button if you got value. Later.